All right, so the Federal Reserve just did something that's got everybody talking. Yep, they cut interest rates, but, and this is a big but, this was anything but a simple call. In fact, it was one of the most split, most controversial decisions we've seen in a long time. So let's break down exactly what happened and, more importantly, why. Okay, so here's the big puzzle we need to solve. On one hand, you've got the job market, and it's starting to slow down. Normally, that's a clear signal for the Fed to cut rates, give the economy a little boost. But, and here's the twist, at the exact same time, prices are still stubbornly high, and that usually means you hold rates steady or maybe even hike them. So what gives? Why cut rates now?
This pretty much lays out the entire headache for the Fed. Look at this. On the left, you've got a slowing labor market. Hiring is down, unemployment's creeping up. On the right, inflation is still hot, way above that 2% target. It's like a classic economic tug of war, right? And the Fed is the rope, getting pulled in two completely opposite directions.
And this whole conflict goes right to the heart of what the Fed is supposed to do. Congress basically gave them two main jobs: make sure as many people as possible have work and keep prices stable. It's their dual mandate. Most of the time, it's pretty clear which one needs attention. But what do you do when both are flashing warning signs? Well, that's when things get complicated. And that's exactly where we are right now. All right, so let's dig into the first clue. The big reason they decided to cut: the job market. This quote from Fed Chair Jerome Powell says it all. The downside risks to employment appear to have risen. Now, what does that really mean? It means they're not just reacting to today's numbers. They're looking ahead and seeing trouble on the horizon. This rate cut, it's basically an insurance policy. They're trying to get ahead of a problem before it gets worse. And here is the number that's really got their attention: 4.4% unemployment. Now, on its own, that's not a disaster, not by a long shot, but it's the direction that's worrying. It's been slowly but surely taking up. It's a clear sign that the job market is starting to lose some steam. But wait, it gets even more interesting. It turns out the official data might actually be too rosy. Powell basically said they think the job numbers have been overcounted, maybe by as much as 60,000 jobs a month. Think about that. If that's true, it means recent job growth might not have just been slow, it could have been negative. And that, right there, is a huge reason they decided to act. Okay, so that's the story on jobs. It's looking shaky. But that's only half the picture. Now we've got to flip the coin and look at the other side of the problem: inflation. And this chart lays it out perfectly. Inflation is sitting at 2.8%. Now, yes, that's way better than it was, for sure. But the Fed's target, their goal, is 2%. So we're still running hot. And this is exactly why so many people thought cutting rates right now was a really risky move. So what's keeping prices so high? Well, according to the Fed, a huge part of the blame goes to one thing: tariffs. Powell's point is that if you look at the price of goods, things that are affected by tariffs, that's where you see the big jumps. Prices for services, on the other hand, have been much more behaved. And this next part is absolutely crucial to understanding why they made this call. Powell sees the effect of these tariffs as a one-time shift. Basically, it's like a temporary speed bump, not a permanent problem. They're essentially betting that they can look through this spike in prices, assuming it'll settle down on its own. And that belief, right or wrong, is what allowed them to pivot and focus on what they see as the bigger danger: the weakening job market. So, there you have it, a shaky job market pulling them one way and stubborn inflation pulling them the other. The Fed was stuck between a rock and a hard place. They had to make a call. And believe me, not everyone was on the same page. And the verdict was a quarter-point rate cut. Just a little nudge to make borrowing a bit cheaper for businesses and for you and me, hoping to give the job market a little bit of a safety net. But honestly, the real story isn't the cut itself. It's the vote, 9-3. A split that wide is incredibly rare. It tells you just how uncertain and deeply divided the folks at the Fed were. This wasn't some obvious, easy call. It was a genuine, down-to-the-wire judgment call with smart people on all sides of the issue. And this table breaks down just how split they were. You had the majority, 9 of them, who went for the small quarter-point cut, trying to balance everything. Then you had 2 hawks who were always more worried about inflation. They wanted to do nothing, just hold rates steady. And then on the complete other side, you had 1 dove who was more worried about jobs. He wanted a bigger cut, a half point. A 3-way split like this, it almost never happens. It's a huge deal. Okay, so they cut the rate. But what happens now? What does this signal for the future? Well, the Fed didn't leave us completely in the dark. They gave us some pretty big clues about what's next.
And this quote right here is probably the single most important thing to remember. We are well positioned to wait and see. Now, that's classic Fed speak. What it really means is don't expect another rate cut anytime soon. They're hitting the pause button. This was a one-and-done adjustment, not the start of a whole new series of cuts.
So why are they pausing? It all comes down to this idea of the neutral interest rate. You can think of it like the Goldilocks zone for the economy, a rate that's not too hot and not too cold. It's not stimulating growth, but it's not slowing it down either. Powell basically thinks that with this last little cut, they've landed right in that neutral zone. And from there, they can just sit back, watch the data roll in, and decide what to do next.
So, let's wrap this up. What's the bottom line for 2026? Number 1, the Fed's main priority has officially shifted. It's less about fighting inflation now and more about protecting jobs. Number 2, they've hit the pause button, so don't expect any more action for a while. And number 3, their own forecast, the famous dot plot, now shows they only expect to cut one more time this entire year. That's it.
Which leaves us with the big, lingering question, right? The Fed may be hitting pause, but the economy sure isn't. That fundamental tug-of-war between jobs and prices is still happening every single day. So what's going to be the next big shock that forces them to act? Will it be unemployment suddenly shooting up, or will it be prices taking off again? We'll have to wait and see.